Okay, good day everyone. This is Capitaland China Trust financial results for FY2023 dated 30th January 2024. Right, we'll do a quick comparison of their current results, which is as of 31st December 2023 versus the third quarter results. Right, so third quarter their occupancy was 93.1%. It has dropped to 91.4%. So clearly this is not a good thing. Right. Shopper traffic and tenant sales has improved substantially, both above 40%, but this is off the COVID recovery, right? Because this is the year-on-year results, right? So given that FY 2022 they were in COVID lockdown and FY 2023 they opened up, right? We do expect that these numbers are substantially higher. Okay, for capital management wise, things are actually quite okay, right? Their cost of debt has gone up from 3.55% to 3.57%, which is not a big increase. So they're still managing this okay-ish, right? In the latest quarter, right? For interest rates, they have gone up from fixed interest rate of 75% to 82%. So this is a good thing, right? Increase in sustainability loans by 1%, right? You can see that gross revenue, right? Whether you compare the second half of 2022 versus 2023 or the full financial year, right? They have gone up, right? MPI has also gone up. But you can see that the thing that really matters to shareholders, which is DPU, right, has gone down by quite substantial 10%. And the basic reason for this is the strong SGD, right? So any REIT with foreign income, right, they have overseas properties and they collect their revenue in foreign currencies. They convert back to SGD, right? The value is less, right, because the SGD is stronger, right? So the other reason is high interest rate costs, right? Right, so we look at their milestones. They divested a mall for this amount, right? We'll see later on that is above valuation, so that's a good thing. It probably suggests that their NAV is actually higher than what they reported, right? And I think what's interesting is they launched this 600 million renminbi offshore bond, right, at a coupon rate of 3.8%, which I think is a decent cost of debt, right? So this thing I think could be beneficial to them, because if you look at this REIT, I think one of the issues is that they collect revenue in renminbi, but they pay their cost of debt in SGD, because their debt is all in SGD, right? So to me, this is the currency problem again that they have, right? So you collect in a weaker currency and you pay in a stronger currency. It's clearly not a good thing for the REIT, right? So I think if they have more currency in they have the more debt in the currency which they collect revenue in, which is renminbi, I think it's overall better for the REIT because they don't have to hedge, right? So if we look at portfolio valuation, right, which is a concern with some REITs because the valuation of their properties have dropped substantially, we can see that for this REIT, it's actually quite good, right? For their retail side, the drop is actually only 0.7%. The business park side also very minimum drop at 0.3%, right? It's only the logistic park that is dragging the performance at 4.3%, right? So the drop here is substantial, but luckily this is quite small, right? So you can see this is quite a small number as compared to the business park, and even much smaller as compared to the retail's portfolio, right? So luckily this thing is very small, so the overall portfolio has only dropped by 0.9%, which is I think okay, right? Given some other REITs have dropped in terms of portfolio valuation substantially. Hopefully this thing doesn't change too much. Alright, so moving on, we can see that the results second half 2023 versus second half 2022 is quite a substantial drop, right? 10.9%, right? But if we is 11.8%, right? But if we were to look at these numbers, right, actually there's another document that shows this better, right? So yeah, this is the actual numbers that was from here, right? So you can see this 50 versus 56, right? These numbers are over here, right? Why I want to show you this document is because if you look at these results, right, there's a one-off additional benefit in this second half, right? 3.6 million that was actually supposed to be from the first half, right? So this number is a bit inflated, right? The real number here, if you minus 3.6 million, is something like 53 is about 53 million, right? So but actually what we are interested is what the actual DPU would have been in the second half 2022 if it had not been boosted by this 3.6 million, right? And the answer is actually here, right? So if it had not been boosted by the 3.6 million, the 2022 second half results would have been 3.18 cents, right, versus the 3.4 cents that they actually gave out, right? So it's a 5.6% drop if I compare the second half 2023 versus the second half 2022, right? Versus if you look at here, it's quite bad. It looks like 11.8%, but in reality, is if you take off the one-off, right, it's a 5.6% drop. However, if we look at year on year, right, it's quite bad. It's really 10%. It's really 2022 they gave out 7.5%, right? Then 2023 they gave out 6.74%. So this is a real 10. If you compare your results, it really looks quite bad. It's 10% drop in DPU, right? But half on half is not too bad. It's actually if we take off the one-off, it's a 5.6% drop, right? So moving on, the price currently is around 73 cents or 73.5 cents. I think it's 73 cents. Sorry, this one could be wrong, right? So, but it's a very little error, so I'm not too super bothered by it, right? You can see that there's a big discount to the NAV, or even adjusted NAV if you are watching this video after they distribute the dividends, right? So you can see balance sheet generally quite okay. You can see the debt has dropped slightly, right, which is a good thing. Gearing has dropped slightly as well. Cost of debt is okay, as we have talked about earlier, very minor increase. Interest coverage ratio has gotten better, right, a little bit better, but is better than getting worse, right? So 3.3x is better than 3.2x, right? Even if you adjust it, it's better, right? You can see that this is the point that I thought was not so good about this REIT. The SG loans percentage is very high, right? So you can see here they project that if there's a 50 basis point increase in the interest rate for SGD, right, they will lose about 1.3% in DPU, right? If the renminbi loans, the change in the interest rate is down by 50 basis points, right, then they will gain 1%, right? The reason why the SGD loans affect the distributable income here so little, right, even though it's such a substantial percentage, is because a lot of it is fixed rate, right? So a lot of the loans are already at fixed rate, so they will not fluctuate even if the interest rates go higher, right? But of course, we are not really expecting interest rates to go higher in the US, so hopefully Singapore won't experience any interest rate increase. And you can see that based on this projection, I think they expect that the renminbi loans, the interest rate to drop. And that's why I think that one of the substantial good things about this report is actually the fact that they're starting to issue loans in renminbi, which we expect that the interest rates will be going downwards, right? So that hopefully can reduce their amount of their average cost of debt, basically, right? So moving forward, I don't think their refinancing is an issue. They've already covered this $100 million, right? Right, the rest is quite small relative to their size, right? So yeah, DPU wise at 3 cents, right? I assume the price was 73.5 cents, but I checked that actually it's 73 cents. Okay, so apologize for this mistake, but I think it's a very minor mistake, right? So anyway, if I analyze this, right, because this is for half a year, if I analyze to full year, they give 6 Singapore cents, right? Then it's 8% yield. But if you want to look at the full financial year of 2023, right, then it will be 9.17% yield, right? Note that these two numbers are based off 73.5 cents, right, which the actual price today as of this recording is 73 cents, right? But the price has been fluctuating between these two numbers in recent times, right? So I think I will not discuss too much about this. We already know that this substantially a retail side of it basically is more or less a 75% retail REIT, then the rest is either business park or the logistics park. And actually this thing is the one that is not doing well, right? So geographical diversification, you can have a look. Basically everything is in China. I don't think I will be discussing too much about this, right? Okay, so we can just look at the retail side, right? Actually retail occupancy has been quite good, and you see that there's a positive outward trend, right? You can see that every number is getting better and better, right? So retail side is doing well, and I think we are quite happy about this. And note that this is 75% of the portfolio, right? You can see these numbers we've discussed before. I won't talk about them, right? So everything has improved substantially, right? Then we move on to look at lease expiry. We can see that the lease expiry seems to be quite substantial for 2024, but given that the retail side is doing quite well, right, hopefully the lease expiry here is actually a good thing. They can actually get tenants that pay higher rent, right? On the other hand, for the other two parts, right, for example, the new economy portfolio, which is the business part, right? This one I'm a little bit more concerned, because the business part, the rental revision is okay, but the logistic part, you can see the rental revision is very bad at minus 20%, right? And you can see the business part more or less is flat performance, right? So around 90+%, slightly above 90% occupancy. You can see some business parks are doing very badly. I don't know why this business park is perpetually at 70+%. Whereas if you look at logistics, right, I think it's even worse, right? Or at least in the most recent numbers are quite bad. You can see this number, right, actually 98%, then suddenly becomes 60%. So it's a drop of 38% occupancy, right? So this is a very bad number, right? And this part here is even, I would consider this even worse, because it is quite clear that there's no demand, right? It's for a long time there is something like 30+% vacancy. I'm not sure why, right? So the logistic park is just not doing well. You can see rental revisions are minus 20%, and they have two logistic parks that are like quite empty, right? Yeah, so logistics for the renewal, this one is a concern, right? This might cause a drop in DPU, right? Because I'm not sure whether they can fill in the leases that are coming up to expire in the near future here, right? So yeah, the last thing I just want to look at is just so I think this is the business outlook, right? So I don't think there's too much to say. It's just that China is trying to recover from its property issues, right? So hopefully they are trying to provoke internal consumption in China. But I think the big ticket items until today, which is something like middle of March 2024, right? I don't think the Chinese appears to be buying big ticket items still, because their housing prices have fallen, and I think because of that, people there are not feeling very rich, so they're not really buying big things, right? So anyway, I'll just quickly go through this part. I don't think there's too much I want to add on, right? Just that, yeah, so this is the bonds I thought about. I thought it was a good thing because it increased natural hedging, right? Even if they have SGD debt and they hedge it, right, for FX, right, that is costly, right? So it's better that they just issue the debt in the currency of their revenue, which is renminbi. It's just better, right? Yeah, so hopefully the retail side improve also, because this mall, the AER is done, right? It came online in July 2023, and also the basement part only came online in December 2023. So hopefully this mall will be able to contribute to higher rental income in 2024, right? So this is a positive. Yeah, so this one has been discussed. So I'll quickly look at balance sheet, right? So for balance sheet, right, their gearing is 41.5% as reported. So how they get this value is they sum their debt here, these two red numbers, to be 1951 million, right? They divide by the total assets to be 4704 million, and that gives you 41.5% gearing. However, they do have perpetual securities, right, which is about 99.6 million. So if I sum this to their interest-bearing borrowings, which is I sum the three red circles, right? I try to sum the three red circles here. The total debt I divided by this blue number, right? Then I get gearing with perpetuals securities, right, at 43.6%. So to me, their real gearing is 43.6%, right? Which should be okay if their property valuations remain steady, which is what I expect moving forward. Okay, as per always, none of this is investment advice, right? And thank you for listening.